All right, welcome back everyone to this week's live stream. So we got a lot to get into this time or this week. We skipped out last week because we had a lot of earnings and I had to be present for all of those. But nonetheless, we still have a good bit of earnings still to look forward to. Of course, we have NVIDIA, Oracle, we have Klarna tomorrow. That one's going to be interesting. After hours today, we have a few that we're paying attention to. Some of them are shorts of ours. I don't think any of our longs are reporting today. I got to remind myself in the calendar. I don't think anything significant, but nonetheless, we'll talk about markets, oil, all that jazz. And yeah, if you guys have any questions, ask away. I'll star them as always in the description. You'll see our sponsors, myself as a sponsor, FinChat, which is doing a sale right now. So you're interested in that, also link it below. But also the timestamps are there. We don't have to follow them strictly, but we're going to adhere to them somewhat. All right, at the 5-minute mark, we're going to get started. And the first topic for today, I'm going to have my schedule here, so I just have it to my right-hand side, is energy. And there's a few things I want to talk about. Mainly, what did the doomers get wrong? This is something I talked about with the members in CM. So a lot of you who are watching, you guys are Capital Mindset members, so you guys already have access to this stuff. We've already talked about this extensively, but just for the public-facing audience, I'll share a little bit on some of the things I've discussed with you guys. All right, great questions already coming in. I'll go ahead and start these questions. I better do TA. I will super chat. NVIDIA will be a top sell-off. Okay. Anyways, sorry if I'm. The camera freezes when I click out, but it should be fine as long as I have a StreamYard here to the side. Okay, so let's first talk about what did folks get wrong with energy, and I'm mainly talking about the hyperbulls. There's a lot of professional energy traders who are at least very well aware of this mechanism, of this relationship, what we're about to get into today. But I'm talking about the ones that were calling for $200 a barrel per oil. And those people, why they were either purposefully misleading investors and trying to corral them in selling a product, or they were just, I don't know, egregiously misinformed and somehow, given their respective career fields, somehow didn't know this. It's almost akin to someone not knowing that the Federal Reserve has control over short-term rates, right? It's almost as equivalent, so it's just as egregious. And that has to do with the relative positioning of nations, of different nation states, and what happens with demand destruction and how that affects supply and consumption. So without further ado, we'll get into and I'll have some slides that I'll use as a sort of a visual. And I will be posting this at some point on X, some of the slides, but this is mainly for CM members and Fraxinus investors that this is available to. It's not like it's a crazy big deal, but we'll talk about, let me see, we'll go with this one first. So it's more of an academic lesson here, but it's understanding how different commodity shocks or how commodity shocks are actually affecting the United States in particular. So we're talking from a US perspective or an American perspective because we are located in the United States. And one of the things that goes against the idea of a commodity shock causing oil price to go to $200 per barrel is this idea that when we see the pain thresholds of different countries, we see the marginal buyer retreat. We see the rejection of higher prices. We call this demand destruction. And simply put, that's like a fancier way of just saying people are saying, I can't pay for that. I can't afford that. So I'm going to consume less. So when supply tightens, which is what's happened, we went through a supply shock, the prices go up, right? And so pretty simple. And then the marginal buyer exits the market. And the marginal buyer in this case, we pointed to Southeast Asia. Basically, you can think of the third world. The third world is the marginal buyer. Their pain threshold is much lower. Their relative incomes are much lower. And commodity prices across the board affect them much more dramatically. An example I keep using is if you were to look at myself, let's say my car that I bought it goes up in price 100 times. At that point, that's a price point where I may not be able to make the numbers work, or it's not really worth my time. However, someone like Bill Gates would be able to still afford the car. And to him, the relationship between that price increase as a percent basis to his net worth is not that big of a deal. And for that individual, for that situation, they're still able to purchase that car, but I am experiencing demand destruction. The demand curve is not moving, but the quantity demanded is moving because the price has changed. In this case, we're talking about, let's say, the supply of said car has gone down. So when it comes to, this example and extrapolating that to the oil market, energy markets, this is a mechanism that is preventing the price from going parabolic at any given point in time. And depends on how extreme it gets, different countries are affected more than others. But the one who gets affected the least is going to be the nation, whatever the wealthier nation is. The wealthier the nation, and also, by the way, there is some attribute to be had about where the resources are sourced from. So the United States also has a bit of an advantage here because it does produce a lot of it. But mainly, the main benefit we're talking about here is the totem pole of wealth. So in this case, the marginal buyer being what we're focusing on, the third world, the first world nations or the developed nations, they're going to be the payment threshold is going to be much higher. And by the time you see demand destruction there, a lot of these other nations, they're in a much more painful scenario. Okay, I'm going here and just making sure I star all the questions. Anyway, so if you have any questions on this topic, I'll be happy to go into it. So, long story short, as the U.S. retains this access, right? U.S. retains this access to this resource. This is why you're not going to likely have a shortage in the United States, but you will have a shortage in countries like the Philippines, in countries like India. You have Prime Minister Modi coming out and saying to the Indian people, like, hey, we need to essentially consume less energy because they are a marginal buyer. Their pain threshold is much lower than it is, for example, the United States. And what this does is it alleviates supply for the buyer like the United States, as an example, or European markets. Now, that being said, it's not that it's worse on a relative sense to where we were before. This is something we talked about in the last live stream, last time we did a live stream as well. But it's not at a level where you see demand destruction. By the time you see true demand destruction in the developed world, the developing world is going to be in a much worse position than they were before. And so this is something that a lot of the hyper bulls in oil, they weren't really appreciating about what the prediction actually meant. The prediction that they were espousing implied a world where there's a massive, severe, destructive depression in most of the world. Because really what you're saying when you say that energy prices are going to lead to very violent forms of demand destruction in the developed world, what you're really saying is the developing world is going to be destroyed into oblivion. And when kind of pressed on that, a lot of them would say, oh, no, I'm not saying that. And in fact, I would go as far as to recall a few of those investors were actually also advocating for EM exposure, emerging market exposure, and saying you should sell the United States, you should sell US stocks and buy emerging market stocks, when that makes no sense whatsoever. When you really think about exactly this relationship, and this is something that it's akin to understanding, when the Federal Reserve controls short-term interest rates. It's not I was having a conversation with a gentleman the other day saying, oh, this is my thesis on it. It's like, no, this is not a thesis. This is a description of a mechanism that occurs. I have a separate thesis, for example, on I think oil is probably going to be higher than it was before, but not, let's say, $200 a barrel, and that there's a short-term risk to oil if you're long oil, the commodity, that it could correct to maybe $80 to $90 a barrel, which would be problematic if your thesis is relying on $200 a barrel. So this isn't so much a thesis; it's a description of a mechanism, similar to how we would talk about interest rates or the bond market, credit spreads, etc. Do not redeem. Exactly. Do not redeem. But all that to be said, and there's a bit of another part that I wanted to focus on, and I'll share this slide here because it's also important. This is something we talked about last year as well. Elasticity analysis is something that everyone should also be doing when you're making or opining on the health of the U.S. Exports and imports. So elasticity is a measure we observe it, visually when you're trying to do your standard demand curve as the slope of the demand curve. So the steeper the slope, we're expressing a more inelastic good or service. And then the smaller the slope, it is going to be a more elastic product. So some of the characteristics of an elastic product that has lots of substitutes, it's not a necessity, things like that. And so the US imports a lot of more elastic products from the rest of the world and exports a lot more inelastic products. So this is a byproduct of the United States hollowing out a lot of its industrial base over the years, and makes a lot of sense because when you're talking about price sensitive industries, those tend to be industries that service more or offer more elastic goods and services. And because it is a race to the bottom, those industries are the ones that leave first because they have to lower the cost because the customer, the end consumer, is very price sensitive. There's a lot of alternatives, et cetera, et cetera. And so that's something to think about when you're talking about what's going on with the rest of the world. There is a world where there's demand destruction in a lot of these other nations, but what the US exports to those nations is more inelastic and ergo going to be less sensitive to changes in price. And the consumption is going to remain somewhat the same, maybe a little bit down in terms of quantity demanded, but all else being equal is going to be a lot less impacted than something like that's elastic. And what's good for those countries that are exporting a lot of elastic products to the United States is that the US consumer still remains really robust and is continuing to consume. But the moment you see demand destruction in the United States is what I was talking about just about 5 to 10 minutes ago. If you saw that demand destruction in the United States, this would dramatically affect a lot of these other countries that are export economies. And so for the time being, the United States is still absorbing and consuming, which is at least alleviating that pressure point, while at the same time, a lot of these foreign countries, their domestic consumption in their economies might be suffering. You're seeing this a lot right now with the market telling you this. So it's not just something that we're talking about in theory. The market is telling you this, expressed through various stock prices. So if you look at, for example, Nubank. Nubank is a very popular FinTwit stock. And we're going to go ahead and pull that up here. Let me show you. So this one gives you a bit of exposure to the economic benefit of Latin America. Nubank holdings down to about $12.82. Throw in Mercado Libre. A lot of this is, in my view, how I'm viewing this and why in the fund, for full disclosure, we sold all of our positions that were somewhat expressionate of this. So in that way, we used that information, that understanding to draw a thesis and exited those positions in good time. And Mercado Libre, for example, I believe the market was looking for a reason to sell. It was already very cautious about the potential for demand destruction in these regions. And you're not going to see that in the current numbers. You would more see that in the next quarter, and the next quarter, and the next quarter. And Mercado Libre is not necessarily the cheapest stock in the world. It's kind of like what we talk about with some software names, where the business itself, fantastic, phenomenal business. It is growing, but it's not something that's trading at 8 times earnings, growing at 30% per year. So it does need to have things go well for it to confirm a thesis in order for the share price to be rewarded. And then you also can look at Grab, for example. That's another FinTwit favorite. This one's also been relatively weak. And then you kind of go down the list. There's quite a few international consumer stocks that have been experiencing clear demand destruction, or at least the beginning signs of it. We've heard from Booking. We've heard from MasterCard, which indicated while North America continues to be strong, in the last Booking's earnings call, they indicated North America continues to be a strong point, but some of their international markets were pretty weak. leading to an initial sort of depressed reaction from the market on booking. And we saw the same thing for MasterCard. Visa's was very positive, but Visa's is much more exposed to North America. MasterCard has exposure to North America, but is much more international focused than Visa. And so it felt that pain threshold. And we had a conversation about that in Capital Mindset right before MasterCard reported. Because again, part due to the thesis, or not the thesis, the potential that we'll observe some form of demand destruction internationally in some of these markets. And so, yeah, the market is telling you that. I think a lot of people might not be reading it that way, but that in a way has a self-correcting mechanism, like we talked about with North American consumption of a lot of these commodities. So what's happening is simply demand destruction, the marginal buyer falling out, and this acts as sort of this resistance point to the price of some of these commodities, which is to the frustration, of course, of these commodity investors. And I understand that. But that's why, I've in I think 2 or 3 live streams ago, we talked about how some of the energy guys I know, they were selling their oil positions because they understand this mechanism. They're not morons. And so one of the larger buyers of oil a few weeks ago, stock price go up, right? Was retail. We saw a lot of retail inflows into oil. And while there are some phenomenal oil companies that, one of them in Canada that I like a lot, I think that retail wanted to pile into something kind of last minute, similar to, in some cases, what's happening with memory. But funny enough, I think memory is a bit more resisted, especially by the FinTwit crowd. Not so much from the accounts that I know that they manage money, but some of the accounts I know that are just, retail guys that love to make content on finance. It's been a lot more resisted. And we'll talk about that a little bit later. Let me see real quick if there's any questions, and then we'll come back to the topic. Great question on Mercado Libre. We'll talk about that. Oh, thank you for reminding me. Okay, so yeah, do you still think Intel's roof is 700 billion? No. So remember when I said that I saw Intel reaching a $700 billion market cap? That's not a ceiling. That was a near-term target. I forget who that individual was. I think that was 2 live streams ago where I talked someone out of shorting Intel. Hopefully that person listened. If you're in the chat, feel free to let me know. It's like I didn't short Intel. I hope you didn't short Intel. But no, that 700 billion market cap that I said those live streams ago, that was a target. That's not a ceiling. In fact, what I would say to you, or what I'll add, is we actually bought more Intel shares. And I'll also disclose I did sell today a covered calls on the Intel position because you're able to get pretty nasty premium, pretty far out the money for short dated contracts. By the way, we're talking like a month out. It's a it could end up getting called away, but we'll see. So it's not a ceiling. I want to be very clear when I say that was a target, not a ceiling. And so right now, depending on what happens with CPUs, what happens with the ramp in fab, and remember, the market will reward it almost like ahead of it. It just needs to know that the orders are going to come through. With the CPU market, you have the potential for supporting, close to $1 trillion market cap, if not more. And then with the fab, depending on, again, the success rate there, that again could support yet, hundreds of billions, if not $1 trillion market cap right there as well. It's not assuming, for example, it's going to get to the market cap of NVIDIA. That's ridiculous. When you consider what the occupation or what NVIDIA occupies in the GPU space and the difference between GPUs and CPUs, of course, the margins implied there, the selling prices, etc. GPUs will still maintain sort of this like profit edge over CPUs. Maybe I'm wrong on that. And then if that's the case, maybe it goes higher. But I think just like from the standpoint of saying CPUs, as far as a product goes, the demand might be so high, this could support a market cap for Intel, at $1 trillion just there. It really does depend on what happens there. But remember that NVIDIA is a $4 or $5 trillion, $5 trillion enterprise. That does not suggest that, Intel, just the CPU business, at least from what I know now, supports a $5 trillion enterprise value or market cap. But remember, we have two components that are going well right now as far as momentum goes for Intel. They're getting more deal announcements, et cetera. But the market will reward it ahead of the actual numbers, which will confuse a lot of investors and say, this doesn't make any sense, et cetera. Similar to what happened to NVIDIA, where a lot of the profit reward for what was happening was much more, 6 months to 8 months to a year down the line from when the stock price started to react. And the forward price to earnings multiple for NVIDIA has been low for quite some time. But I remember, and I was in that camp, right, of saying like, whoa, what the heck is going on with NVIDIA? But once you understand it, a lot of people never understood it afterwards. They didn't course correct. They didn't change their opinion when the facts changed or became a lot more apparent, because it was still fairly fresh and you still had the opportunity to participate in that. And, with TSM, et cetera. Yeah, that's not to say that 700 billion is a ceiling. It was just a target. They achieved it. Upon revisiting, it could definitely support a higher price depending on, how they execute here. And that same thing goes for AMD. That does actually indicate that AMD might also be right place, right time, and could support, still much smaller enterprise than NVIDIA, but could support a market cap, getting close to $1 trillion, if not over $1 trillion. But we'll see. Okay. Cisco earnings are nuts. No, I don't think you heard what I said or have been participating in the prior live streams. The Cisco thesis from 2000s highs paying off now. Absolutely. Yeah. Okay. So anyways, we'll talk about, turning point parental star that. Any other questions? Okay, well, there's questions on Melly. Melly has too many contras. Yeah, there are a lot of people who are long Melly that might be a contra. These current prices take a bite. Melly. So with Melly, you have to take a really long-term view. If you can hold it through that, then good. I think the company will be fine long-term. Can you disclose the CC strike on Intel? The 165s, that's fine. I can disclose that. 165 strike. Toast at the current price, I think is fine. It's again in that basket of, if you're patient on the name, it should work out, but you shouldn't expect a near-term change, because a lot of people keep confusing, and I've said this like a billion times at this point. I'm not saying it because like this is for our first interaction on Toast, by the way, but it's the same is true for a bunch of stocks right now, especially in software. The catalyst that brought down a lot of these stocks was not their earnings reports. So a lot of investors are getting frustrated because they don't understand the simple fact. The earnings isn't what's going to cause the stock price to go up or down. It's the change in perception by the market. So that could happen during an earnings report. But it's not the earnings per se. Oh, we grew sales by this much. We grew profit by this much. This was our guide. The market right now is petrified about what new technologies are going to do to your growth. If it does not get alleviated, that concern, your multiple is going to re-rate. It's going to re-rate to price in the uncertainty that the market doesn't understand what's going on. It doesn't know, like if you're priced at 30 plus times earnings and the market knows you're going to grow roughly 20% per year to 30% per year, the market could support that, reward you, you get a good, good earnings print, raise your guide, etc. It loves you. The moment the market doesn't know that you're going to continue that growth rate and it starts to get worried that something is going to disrupt you, well, not disrupt you, slow down your growth, the market's going to cut that multiple. And that's what you're seeing across the board. So it's not an earnings catalyst. It's not like, oh, Salesforce is going to report the next earnings and then they're going to slightly beat on revenue growth. They're going to slightly beat on profit growth, and they're going to guide slightly above what everyone was expecting. That doesn't necessarily alleviate that original concern. And so that's not the catalyst. So that's why a lot of investors are seeing this happen and they're getting frustrated, but they're not understanding that point. Same thing with like Topicus, Constellation Software, a lot of these favorites. People are not understanding that the reason why the stocks are weak, even though they have, I would say, objectively good earnings for that period, that's not what the market's worried about. And so Toast had good earnings. Everything's moving in the right direction. If you're a believer in its longer term story, you have to show a degree of patience with it if you're wanting to hold it through that. But it's not something that's going to correct itself next quarter potentially. What has to happen between now and catalyst is something. What is that thing? Who knows? Something that alleviates that concern and brings a little bit of clarity, and then the market will reward it again. So what I would say to you is that if you're still penciling out, 20% growth for the next few years in this business and Toast, the valuation I think is pretty attractive if that's what you're penciling out. If you're trying to time the bottom and buy now and be the hero, you could end up doing it, right? That could actually happen. Or you could wait for said catalyst to occur, miss out the first 10%, 15% or so, and then add to the position on conviction. So that's why I'll respond and push on this idea that it's not yet at a price where I'd say, you make it a really large position regardless, because we're still not trading at low single digits or mid single or high single. We're not anywhere near that. We're still in the strong double digit multiple. So that's the same is true for a bunch of these software names. And Toast is maybe unfairly categorized here, by the way, but nonetheless it is. So I'm going to continue to utilize that. And that point of view, that positioning that Toast has, it's not at a price where it's like ridiculous, or it's not like, oh, the downside is extremely minimal. Because an example, for certain, if the growth were to slow down, Toast's multiple won't support that for sure. But like, for example, if you pick up a stock, hypothetically, an example I can give you that everyone knows and remembers: Meta, Netflix, Alphabet, Dave. These stocks that they at some point in time, the market trades them at an extraordinarily low multiple, and they're still growing at a really attractive pace, but that's fewer and far between. Something like Meta is extraordinarily rare because it has so many eyes and ears on it. Alphabet was going through some existential crisis with multiple negative catalysts. Netflix was in the midst. Well, I used to say Meta too. Netflix was also fairly rare, but it didn't get as low as Meta did. But it was in the midst of a bear market and had a lot of negative press and printed bad numbers with growing their user base, even though when you factored that out of Russia exiting the Russian market, they grew. But nonetheless, a lot of negative press there, and the market generally was weak. So those multiples that they achieved while still having decent growth, that's more of like the scenario I'm describing, when that's not what we're looking at with Toast. It's not really what we're looking at with Salesforce or ServiceNow. We're still looking at pretty elevated multiples when you look at the broader market. I think Salesforce is still Salesforce has fallen even more. So Salesforce, I think, is below 20 times earnings. ServiceNow is definitely above 20 times earnings. So what that means, or that implies, is like, let's say the growth on ServiceNow collapses from 20% to 10%, then the market sell-off and the market fear was completely justified. Of course, the ServiceNow shouldn't trade at double the multiple it was before. That makes no sense. But if, for example, you get ServiceNow at, let's say, make up a number, 10 times earnings, but and the numbers currently show, but you also know it's going to continue. They're going to continue to compound at 20% per year. That's an example of when you say you hold your nose and you buy. If you're trying to express that you understand the business is going to continue to compound at 20% and it's trading at 10 or below times earnings, but that's not where we're at now. And so same thing with Toast. So with Toast, you are expressing that the business for sure is going to grow at that rate, but if you're trying to time the bottom, do not be upset with yourself or disappointed or angry with the world and frustrated with the market that the market doesn't see it yet and trades the stock down a little bit further because it still has room to give in that multiple. Anyways. This is also why EFX is not. Yes, Equifax is not trading at a crazy low multiple right now. Equifax is still trading at, I believe, close to 20 times earnings or more. I forget what the gap figures are. Let's actually look at the trailing 12-month gap. We'll ignore forward for a little bit. Let me just see. Okay, so trailing's at 28, and I think forward is like 20 or something. So it's not at a single-digit multiple, right? It's not at an ultra low multiple where you say, this thing's still going to grow double digits, really strong double digits. It's safe buy. The market could compress that multiple easily because I've seen worse. I've seen it happen over and over and over and over again, so many times throughout all the years. It's 28 times earnings is not something that's like incompressible. So yeah, it totally can happen. So that's why I say it's like you can be the hero, you can jump in, but try to think about what is the market afraid of. So then what is the market looking for it to not be afraid of? And then you ask yourself, it's like if your target is 10% allocation to Equifax, do you want to buy all the 10% right now? Because what you're stating when you do that is like it won't go down any further. This is the bottom, which maybe it is, but maybe it's not. Okay. What's cooler, benching 135 or weighted pull-ups with 20 pounds? Definitely the pull-ups, because I think 135 is like, I mean, it's a standard. You should at least be benching your body weight, I think, at least. So unless you're 135, but pull-ups with 20 pounds extra is much, much more impressive. Or much cooler, I wouldn't say. Isn't now the time to sell semis trading at peak cyclical earnings? Or I think you meant peak cyclical earnings and defensives and healthcare trading decade lows when no one wants them. Well, actually, correction on that. Healthcare was the time to buy. Healthcare has recovered a lot. And some of them are still cheap. So you have, I think Molina, which we're long disclosure, is still cheap. It's recovered a lot. I think now it's at like close to $200. I own United in my personal account, and I'm just going to hold that almost forever. But yeah, those are, I think, let me see, United, I think crossed 400. I saw in my account today. Yeah, 401. So a lot of these have recovered. I wouldn't really rush to buy them now, because now I think the price is now reflecting that the medical loss ratios are going to substantially improve, yada, yada, yada. So I would add a correction to you. The defense companies, it depends on what you're talking about. You're talking about military defense. Those are going to start to get interesting because you have a lot of things weighing down on them. You have the potential that, the US and China don't increase tension. Again, this is just sentiment, because fundamentally it doesn't really matter too much because the procurement budget is still going to go up, which will benefit them. But nonetheless, the sentiment, I can't fight, I can hate it all I want, but it is what it is. And there's this perception that the Iran war thing is winding down. So, that's hurting defense stocks. But I'm bullish, Northrop Grumman, ultra long term, et cetera. And they're starting to get interesting again. That one, if you mean by that defense, yeah. When you're talking about staples, well, some of the staple firms, they're growing at bond-like rates, and I think they're still, you know, I mean, sure, you could buy it and then someone is going to offer you a higher price for it, but fundamentally, they're not very attractive to me. Now, the statement in and of itself adds an assumption on the cyclical high. So you're also making an assumption that, as an example, the investors you're talking to are buying today, May 13th, 2026. So that's the wrong assumption. I think most of the folks, especially maybe in the chat, they've been invested in it. But I'll entertain it regardless. If you're trying to predict the cyclical high here, I'd turn the question around and say, why do you think it's the absolute high right now? Or what gives you the confidence to say that? It might be, but I would just like to know what is drawing you to that conclusion, because that's actually part of the second topic, which was about the semis being the most hated, or not hated, or the most hated, but it is a hated rally because a lot of folks missed the run up, and there's been a lot of direct plays, indirect plays in semis. You have a lot of more niche parts of the semi industry that are doing really well right now and started finally to pick up. We're invested in one new theme that will be a lot more impacted in 2027, and it only actually just had most of its returns this year in 2026. But you'd have to have an opinion on where investment is going. And then from there, you can map out what you think the price action is to follow, because where are the earnings going to follow? But some of the memory stocks, for example, they're going to earn their entire market cap in profit over the next few years. And frankly, there isn't that much of a supply increase coming online, which is really all you're paying attention to when you're trying to determine how much that profit is going to actually be realized or not. And if for example, the supply crunch keeps going till 2028, then at that point, you're still looking at, well, they're moving all the time, but from just like a month ago or so, you would still get projected probably still decent return. If it lasts till 2029, then there's still more implied room. If it is a structural change in how folks are investing and swiping through, and depending on how impactful AI is on the economy and productivity, then it could be very difficult to model what that looks like. But at one point in time, in maybe the not too distant future, it will be good for profit taking to occur. Yes, of course, at some point. It's not like it's an evergreen position. But I see it all the time. I see a lot of retail investors, especially, they're very frustrated. It's almost like this anger they carry with them about semis because they missed it. So yeah, we'll see what happens with Klarna tomorrow. Oh wait, there's so many questions coming. Dave, good earnings. Stock went down on like Sezzle. Any explanation? Yeah, no comment. No comment on the question. Current take on TSSI after last week's earnings. Well, TSSI, we're not long. TSSI, we were long. We're not long. We actually closed out our position quite literally a few days before earnings. But no, we don't even have plans to re-enter TSSI. We kind of concluded that position, done with. But I did I did mention to the members that well, you can't get a bid now, but the day of and the day after, you could have sold pretty nice puts at the 750 strike for decent premium. If you try now, I don't think you're going to get a bid, because I tried today because I saw the quoted price was attractive enough. So I put a limit order in and I didn't get a fill. But TSSI's earnings, I think just in general, they're kind of muted right now as far as they go into their expansion. They're hitting the, basically the minimums Dell offered them, but Dell's helping them, roll out some CapEx to increase their capacity. But in general, I mean, it's a fine play. It's got some, potential torque to it. It's going to be very volatile. But there's cleaner and better ways to play that theme with what we view as like, less of a headache dealing with the fact that at any point in time in the not too distant future, potentially your station, your positioning with Dell and relationship with Dell could be a threat, because you're just a Dell proxy. So but yeah. Okay, great question. Any thoughts on SPG? I like all of these companies, but no position. I like them. ACGL. Wait, let me remind myself. I want to make sure I'm not talking about the wrong one. Okay, Arch Capital. Yeah. So Arch Capital, they do a few things, right? They have the PMI business, the reinsurance business, etc. Decent capital allocators over time. They've been transforming themselves. Insurance as a sector is right now hated. So if you're trying to pick a sector that might have some interesting plays, it's definitely insurance. So we're talking about PNC, so property casualty. Sorry, I shouldn't use a property casualty. So, think of auto insurance, think of Progressive, Chubb, Allstate. You got some of the smaller companies, Root. You have the ENS and Kinsale, Markel. You have Arch Capital Group, which is PMI, reinsurance, etc. Everest, which is their competitor. You have the PMIs, NMIH, MTG, etc. You have PLMR for earthquake insurance. You got IGIC. So all of them, you can kind of get a basket right now and pick out a list of companies you like. Again, kind of like the same thing. When will they bottom? Who knows? Do you have the patience to hold it the whole way through? That's a personal question. And are you willing to miss out maybe the first couple percent on some sort of turnaround? But structurally, a lot of the businesses are doing fine. Some of them are still over earning. I'll give you an example. ACIC, which is a property insurer in Florida, they're still over earning. They admitted as such. So that's going to be a bit of a headwind. They're still in a soft market now. And remember that insurance is very cyclical. You go through the cycle of hard market, soft market, hard market, soft market, hard market, soft market. Then you also have the insurance brokers. You have Arthur G. Gallagher, Brown and Brown. These guys are also suffering a little bit right now. We got premiums in general. There's pressure on them, so that's hurting the organic growth for a lot of these insurance brokers. So they're growing mainly through M&A. Arthur J. Gallagher actually had decent organic growth, but Brown and Brown disappointed the market with their organic growth, and the market punished them. So a lot of high quality businesses in this basket. Arch Capital Group is one of them. You can't really go wrong with most of the names I mentioned. It's really about, when do you accumulate at a large scale if you want to, because just to be clear, your portfolio will do just fine if you never touch an insurance company or a bank or any of these. So, some people have rules like, oh, I don't touch insurance companies. Oh, I don't touch banks. You'll be perfectly fine if you don't. But if you want to, or if you like these businesses, they're all going through a pain cycle. The multiple on Kinsale, for example, has gotten absolutely crushed, but so has the growth as they've entered the soft market. But honestly positive for that management team there, because they're actually showing underwriting discipline. They're not chasing. They're not saying, oh, in order to just keep growing, we're just going to lower our standards. Insurance is a game of hot potato. So the insurance, just like when we talked about healthcare, how United Health really fucked up with what they did. They wanted to grow just to grow, and this allowed them to fall for this game of hot potato, where they held the hot potato and they burned their hands. As CVS unloaded their business in some states, United Health picked it up, and I jokingly say it's like the meme of like United Health's like, oh, I can change her. They took unprofitable policies and tried to make them profitable, and found out they're just not profitable policies. So the same thing happens all the time in every insurance category, whether it's auto, property, etc. You'll see aggressive market share take, only to get clapped when the risk happens and you weren't charging enough for that risk. Anyway, so of the names here, I like them all. Transfer wise, there's I put a pause on that one of like completely endorsing it, just because I don't know or fully grasp the potential consequences of new technologies that might circumnavigate them. But I don't have any negative thoughts on the company. We tend to view them in a positive light. The first one, SPGI, I think that company is going to be more than fine. AI is not going to be disrupting that moat anytime soon. So I like them all, though. The one I'm more hesitant with TransferWise, Arch Capital. While I do prefer some of their other insurance companies out there, I don't hate Arch Capital. I think they're fine. I think they have a good management team. I like them more than Everest. I think they're one of the best reinsurers. And that PMI business they have is like cash cow for them. So I don't hate them. BLDR does not like macro. Remember, tied to interest rates as well. That's going to dictate. And remember that also Builders Catalyst already happened, which was their earnings, unless one of their peers reports and the market likes that. But from here till the next catalyst, you have traders who are in control there. And the negative perception around what interest rates are going to do to housing, whether true or not for new housing, is irrelevant. And the report, remember, it always lags builder. So builders had a little bit of an uptick in starts. That won't show up for builder at least for another quarter or so. So builder right now on a TA, if you're into that, it really doesn't have much until like the 50s. So you could actually end up seeing builder around $50 per share. And if it gets there before the next catalyst, I think that would be an interesting setup. Not saying it gets there, by the way. I'm just saying it could get there, and I wouldn't be surprised or shocked. For Amazon, at what point do you believe the law of large numbers really sets in hard? It's hard for me to envision a scenario where they see 300 billion plus in operating income with room to expand. Well, so cloud genuinely doesn't have a visible ceiling right now. As you can see, the demand for compute globally is astronomical. The retail side of the business does have that law of large numbers play to it. But in there, you have a lot of optionality for price increases with Prime. You also have ads. So the ads business is really how they're going to drive margins. And that margin is how they're going to get operating leverage and how they can actually squeeze out more profit. So yeah, between those two things, I'd say they still have more room. If you're telling me, at 5x from here, yeah, I'd have a difficulty making that case. But, I'd probably, see Amazon at least like at a 4 to 5 trillion market cap in its future. I don't think that's a hard ask. Thoughts on Juice hedge fund returns? January is pretty impressive to me. Oh yeah, so folks on X were posting this one fund manager's returns, because to his investors, I think it's one of his investors leaked it, because it's kind of egregious that he left out January. So it's a leaked document from my understanding, but he just left out the January returns. And well, there's another fund manager that we'll talk about later. But yes, thoughts on that was I didn't know that was legal to do that to your investors. Brazilian stock, interesting. Stoneco. I've never been interested in Stoneco. It always looked cheap, but I don't know. I can't bring myself. Some of the org structure also is like questionable to me. When I look at Brazil and I want exposure to Brazil, I'll always look at Meli or Nubank first if I want that. I have more confidence in their teams. But no, I don't have a negative opinion on Stoke. I just don't have a positive opinion either. I'm neutral. Oh, so it was you. Okay, so no, you're welcome. I'm happy you didn't short Intel. Yeah. So I'm happy to help, man. That made me cry. Also, a question, long-term thought. Oh yeah, so I shared my thoughts on Builder. Is inflation not a concern in any scenario? I thought the market was worried about it even in Feb. I think the market is being a bit rational with inflation. So there's a few different kinds of inflation. So not all inflation is created equal. The Fed actually talks about this a lot when they say we have to look through or look past. So you have cost plus inflation. And cost plus inflation can also be created by different factors. One of them being a supply shock, which in this case, that's what this is. So when it's a supply shock, it's not the inflation that the Fed is concerned about. And the market looks at a supply shock. Well, we talked about in the beginning about, absorption, et cetera. At this current level, it's not that bad. Of course, there's a scenario where it can get bad, right? If you had $200 per barrel per oil, yes, that's bad. Remember that when I shared this in the past, the inflation adjusted price of oil. When you look at it from that perspective, it's actually not that bad, believe it or not. So you have to, I try to not be a doomer, right? And try to help you guys out and give you guys some anti-doomer stuff. So that's one. The price of oil adjusted for inflation over the years is actually still not that bad. At $60 a barrel, it's insane. There's some fund managers out there who are really bearish oil and are saying $30 a barrel. I'm like, how? I don't understand that. I'm more so in the camp that oil gets back down to $80 to $90 a barrel. And that's sort of like a newer level for it. I don't think it gets back to 60. And I'd be shocked into oblivion if it got to $30 a barrel. That's crazy. And I also reject the notion it's going to go to $200 a barrel. But yeah, so in this case, inflation is driven by that. Remember that inflation can also be driven by the expansion of money supply. Expansion of money supply, believe it or not, is not so much to do with the Fed as much as it has to do with lending. So the banks create money. And that's what the Fed is trying to really control for and pushing aggregate demand up and down. They have no impact on supply. So this kind of inflation, the market is not as concerned about because it's viewing it as something that is manageable and course correctable, but not something that can be done with monetary policy. And the Fed, hopefully, which I think they are, because based off the commentary, they're looking past it. But we'll see, because they're not going to raise rates into that, because you can't, you can't reduce aggregate demand, and then that's the way you fix inflation, by a supply shock driven inflation. So can't do it. As a single digit multiple with double digit growth, yes. NMIH, the multiple has compressed a lot. So I'll show you. Let me get FinChat out, because FinChat's perfect for this visual. Okay. So again, sponsored by FinChat, link in the description. I'll show you guys what to kind of look at here. Let me try to zoom in and make sure you guys can see this. So we go to the ratios section and we go to the price to book. I think we go to per share. Oh, let's just do book value per share. Oh, let me get rid of the percent. Oh, I don't want to see too many lines. All right. Book value per share. And then we'll do a valuation, price to book. We'll include that. So book value per share and price to book. This is sort of the better way to look at the multiple, not so much the PE. So let me hide this one real quick. So we're just looking at the price to book. So price to book compressed a lot. And this is the story since about 2024. The price to book has been compressing. And the price to book was egregious pre-COVID. So the return profile of NMIH versus something like an MTG is actually worse, but not because the business did worse. The multiple has compressed. So the multiple, if you look at price to book versus MTG, which is a peer, MTG back here, you were paying a much lower price to book. And so, of course, it outperformed. Now, price to book as a function like what the market is willing to pay for something like an NMIH is going to be a proxy of how much it's going to grow book value by. So one kind of smell test, if you look at return on equity is a smell test of how much they're growing book value. It's not going to be perfect like 1-to-1, but it's going to give you an idea. So essentially, this is one way I can tell you. So if you pay 1 times book for NMIH, and it continues to grow its book at roughly this percentage rate, right? That's roughly what it's actually growing it by. And we're going to look at it on a quarterly basis. So you can see this inflection here. So that it improved from last quarter. But if they continue to grow book value at a healthy clip, you should, in theory, get a return commensurate with that growth in book value. So you just want to make sure you're not overpaying over book for that growth in book value. Don't be distracted by the price to earnings multiple. It's going to be more of a function. And if the market ever does that, like if you ever see the market trading it at an extremely high, and it's not like an accounting error, that's your time perhaps to exit. Or if you're looking at it and the market's offering you close to 2 times book, you could consider, that's like either definitely not add or exit. And then if the market could always trade under book. So again, it's going to be more of a function of what it's growing its book value at. And one way to think about it is it's kind of like a PEG ratio. It's kind of like because it's not a PE, but it's like a PBG. So price to book ratio divided by growth. How much is it growing said book value by? If it's doubling book value every year, it's probably going to trade at a high book value. So, an example, alternatively, we'll look at like Progressive. So Progressive trades at a massive premium to book, but if you see roughly like what they grow book value at, it'll make a lot more sense. So if I go to price to book or book value per share, let's go price to book. So PB, you can see that it trades at 3.5. At one point, it's trading at 6 times price to book, but right now it's at 3.5. And if I show you the book value per share growth, this will make more sense because, again, it's, we'll do the percent change for this. So you can see when the premium, I should have kept the price to book. My bad, because I can overlay that. So you can kind of see what I'm talking about here. When the price to book is really high, what's obviously happening at that point in time, the market's rewarding and thinking, wow, you're growing book value at a really nice clip. And then if that compresses, and you know what that will follow, like I said before, that will tend to follow, not perfectly, but in capital efficiency, that will tend to follow return on equity. Okay. Oh, did I click the right one? No, that's not the return on equity. Oh, that's quarterly. I apologize. So this is a little fucked right now because that's quarterly. So that's really high. So remember, NMI's was like 15 plus percent annualized and like 4% quarterly. This is quarterly. So this is ridiculous. And then the book value changes showing annual. So this is fucked right now. Let me switch everything to annual. So it makes a little bit more sense there. It's loading. Okay. Yeah, this will make more sense now. So before I was like, what, this is too low. Because I somewhat know or memorized what a Progressive's numbers are. So yeah, you can see here that the book value per share growth is declining now to 10%. And the ROE aside from 2022, and I'll go back to quarterly, I think it's beginning to normalize a little bit. So you see this like nice little dip here, and it sounds like nothing, but the market gets really fickle. And again, that's not going to follow perfectly, and the market might be implying. Oh well, also actually scratch that. I know what's actually also missing in this explanation. ROE, depending on, and this might not be the best one for Progressive because Progressive is a little different. The one that we want, I'm gonna have to create my own. Yeah, because Progressive does have a little bit of an attribute that increases its ROE or keeps it consistent. I'm not gonna create my own. If I look at book value per share growth, that's fine because it's more of the best proxy. But book value per share growth sort of following in line with that. And the policy growth right now, if I go to, I think I see in KPIs. Yeah, right here, this line here, you should see that the growth rate is starting to decline, and the market's getting worried that this declining growth is going to start to get negative. But I still think Progressive's a great business, and the multiple is now more reflective of something that you don't have to, have such high expectations of. And the property side of the business is growing. Okay. Also, you want to mention this to your business that are both pretty surefire, long-term winners, SaaS, best of breed, Melly, etc., and are also trading for cheap price today. Okay. If not disrupted, cheap-ish is like Topicus and software. Adobe is very cheap. I just don't have a great opinion on whether or not the growth rate is going to decline further. Salesforce. So some of these, if they're switching from a subscription seat-based to usage-based, I believe there's a really strong case that for a lot of these, the margins are actually going to compress. And I think after that, and you get more clarity on the new model, I think a lot of these names become viable. But until then, it's just like, I don't know what I'm modeling. I have no idea what I'm looking at. And I don't even think software guys do. Software guys just know the product's not going away, but we don't know what the numbers look like. But yeah, like, Topicus in theory looks fine. Microsoft also, I think, looks fine if you're talking software. Oh, but you're also expanding it because like Melly's in there. So best of breed. Now that's like pretty expansive now. Cheap-ish, like best of breed. Arthur J. Gallagher is looking pretty cheap. I don't know if in the categorization you're looking for distressed, so companies that have sold off. Because if you want companies that are not sold off and are continuing to do really well, there's a few others. In fintech, you have Dave and Affirm. Affirm's best of breed in consumer lending. But yeah, I don't know if the qualifier is only companies that are right now at like a 52-week low or whatever. But yeah, that would be a few names. Weird question: social media noise and news. Where can we see drawdown coming? Weird question. With all the social media noise and news, seems like we still can't see a drawdown coming. How do you forecast it? That's the best part. You don't. No, but seriously. So, I think the drawdowns themselves, you can help yourself out by a few things. You can help yourself out by either doing a long short portfolio. Okay, let me say it this way. In portfolio theory, you can't escape volatility, really. If you're escaping volatility, if you're reducing volatility, you're doing one of few things. You're either, creating some sort of measure of we're seeking alpha, right? You're seeking alpha by longing things that will go up and shorting things that will go down, of some kind, or you're reducing your risk, or you're reducing your exposure to equity. But predicting when something will go down macro wise is easier said than done to do consistently. So it's not a practice you should go and pursue. The best you can do, honestly, is your reaction to a crisis, or not to a crisis, quote unquote, but to sell-offs. Like, do you have the sound mind to look through the sell-off and not be one of these fund managers, which I still haven't talked about? He's closing his fund because he severely underperformed because he got super bearish because he has TDS. He allowed politics to get in the way of making money. But you don't want to be like that. You don't want to have your mind completely clouded and have it happen to you twice in a year, which is the problem. So SVB, Silicon Valley Bank, that's tough to see coming. You used a good example of something that's like, you can't really see that coming unless you're working, maybe close with that bank, or you're, talking to an insider at that bank and they're letting you know, it's like, oh, things are, we don't, if there's a run in a short amount of time, we're done for. But what you can do is, like, in the midst of the bank sell-off, you can, for example, find some banks that are really good price and buy them, and you would have done well. You can sometimes, like, you can see an example like the liquidity crunch back in like 2022, because I was like slow moving. So there was a lot of moving pieces in the bond market there, but that's not really the ones that you're really talking about. You're more so talking about almost like these like mini crises that have this like dramatic impact. And we had one last year with tariffs. Like, how can you see tariffs coming? Well, frankly, there's two ways of looking at it. The tariffs, you could argue, it's like you're surprised why people react so strongly to it, and vice versa, because then people would say, why are people still not reacting strongly to it? I don't know. But no, you can't, trying to time these events. I think it's a losing battle, man. Again, you can have like a long short portfolio, and that will, if you're doing it right, will smooth it out. Because in the fund, for example, we're long short. And Andrew manages that book pretty much, and he's killing it. But otherwise, embrace the volatility, man. Embrace the volatility. Is Meta currently your favorite Mag 7 stock? Have you had zero exposure to any? Yes, we do like Meta. Yeah. We've been buying some leaps on Meta. I'll disclose that. So disclosure, we're long Meta, obviously. But yeah, no, I like Meta a lot. Someone tell Discord, my man. What is the bear case for Melly? Long term, long enough term, no bear case. Short term, severe demand destruction in Latin America. What is a good memory stock now? Memory. So believe it or not, SanDisk might still be not at its top, but SK Hynix has been our favorite. SK Square, if you can get your hands on it, is good. I mean, I think you just can't go wrong with SK. I prefer SK much more over Micron. Wow, I need to catch up with comments. Let's go. Speed run. Finally, someone is not doom and gloom on YouTube. Fave stuff seems to be ultra negative. Yeah, I know. It's fucking stupid. but that's what gets clicks, is like, if I sit here and tell you guys are all fucked, you get more clicks. If I do like you know what the thumbnail needs to be? You got to do like something like this, like, and fire, and it's like, you're all cooked. Wait, I stole your stuff on Twitter. Oh, the Too Soon Jr. Finally, sensible voice, strongman has gone nuts. Is he gone bearish? Thoughts on Maine? Oh, okay. So Maine I like out of the BDCs. So everyone he's talking about Main Street Capital. So if you're going to pick a BDC, I'd go with an internally managed one, which you have Main and Hercules. Main Street still trades at a premium. So if you look at the NAV, I believe the premium to NAV. Let me see if I find it quick. Oh, I can't use this one. Okay. Yeah. Bro wants me to talk about it. Okay, I'll talk about it. I saw the comment. Okay, so it's trading right now at a 71% premium. So the NAV is like 33, 34. So keep that in mind. You're not buying, the stock ultra cheap. You're buying it at a premium. It deserves a premium. You're buying it at a premium. I think Hercules, you're buying it at just the NAV. And when you're looking at BDCs, you got to be looking at NAV as sort of like the taste of how cheap it is. But Main Street, really well managed. Private credit just isn't it's not really well liked right now. And you also have to be concerned about credit spreads. So that could affect the multiple, the premium or discount to NAV. But no, if you're, again, this is sort of like if you have a longer term view on Main Street and you're saying, I want BDC exposure, I think you could choose much worse than Main Street. But just keep that in mind that it does trade a premium to NAV. And technically, there's nothing saying it can't trade at a discount to NAV. It could totally happen. Happens all the time. But historically, the management team at Main Street has been actually really good. It's internally managed, so you have better alignment with the management team. Same with Hercules. There's a few other internally managed ones, but externally managed, sometimes they're more asset gatherers than they are fully in terms of aligned with the shareholders. I'll put a star on this one. Don't you think Microsoft is the best big tech? Yeah, no, I like Microsoft a lot. I think it's a good risk reward. Canada has one good oil co trading at all-time highs. Yes. And I do like it a lot. No rates coming down. Nope, not the year of REITs. Thoughts on Roblox? I don't have any. Oh, I think Roblox had some news come out about something with children, like today or something. Okay, looks like it had an initial dip and then subsequently recovered. But anyways, Roblox fell on earnings. I don't understand the product. The numbers kind of make sense to me, but I don't understand the product. So I can't really opine on anything else because then I don't understand how sticky it is. Chime versus Klarna versus Marqeta. Which one do you like more? No Dave or Affirm. I think I'd have to go with, okay, so I have to go with Klarna for the upside, Chime for the stability. CoStar, we like a lot. We were actually just talking about CoStar Group, Andrew and I, when we were doing our weekend planning of what to look into. CoStar is on our list. I like the business. I'm aware of them and all their products. What the heck happened to PDFS? Andrew Rugpool, what can I say? I would say you make one doom and gloom statement. What statement would it be? The only doom and gloom scenario I saw that I thought the probability went down a lot was U.S. conflict over Taiwan, but I think that's mostly not going to happen now. If you could make one doom and gloom statement based on market conditions today, yeah, it would be that. But macro-wise, the U.S. is still really good. I think Canada. Oh, I have a Canadian audience, so I want to give you guys a bit of a jolt in spirit. So Canada is actually, and we've had these conversations in CM about Canadian macro, and one of the things we noticed a year or so ago was the mainly in 2025 was the complete drop off in business borrowing. So corporate lending across Canada was pretty abysmal, which makes sense, and that preludes, what we see in the current macro for Canada. It goes down, it's upstream of the jobs, etc. That's going to correct itself once USMCA gets re-signed because it's going to provide clarity. So macro on Canada, you guys are going through a tough time right now, but that should start to clear up here post summer. So it'll take a little bit for the engine to start spinning again, but it's not going to be like some sort of like nirvana renaissance economically, but things will improve from where they are now, and so that's something bullish you guys have to look forward to. And so if there's any Canadian specific macro bets, like I'd say probably Canadian Pacific or Canadian National Railway is one way to play it. But, I think if you can think of, I guess you Canadians probably know some local stocks that could benefit. That could be, bullish generally the Canadian market. But in all honesty, there's nothing really crazy besides was the Taiwan conflict. Because a Taiwan conflict or a conflict of that scale would throw a lot of things off and cause the sell-off of sell-offs. It would be a pretty bad scenario. But macro rise, like private credit isn't as doom and gloom as what some people are saying. The consumer is actually relatively strong, despite what clowns are saying, especially some companies like Kraft Heinz. Like, who the fuck cares about what Kraft Heinz has to say? But they're struggling. And then I'm literally reading the report. I was like, that's a skill issue. Or Whirlpool. It's like, oh, the Iran conflict made people stop buying, your units. Oh, yeah, that makes sense. Only you are saying that. And then all the other consumer discretionary companies, most of them at least, are actually reporting the opposite. Oh, the banks who actually have insight into consumer balance sheets, they're seeing that it's good. But you know better, Whirlpool and Kraft Heinz. So, are you long app? Yes, we are long app. Are you familiar with DSP? Yes, we're familiar with DSP, but yeah. No comment on that. My understanding on app, and Andrew's the one who knows a little bit more about the ad tech space, so it's something he would probably be better suited to answer. But we know DSP is cheap. It's been cheap for a while. And actually, let me see what the stock price is at now these days. It's been a while, but they used to have a really, I think they probably still do, pretty massive cash position. Well, it's been cut quite a bit. But anyways, like AppLovin, what I find attractive there is what's happening with the Axon product. That might end up actually being something quite interesting, and their foray into e-commerce advertisement could be very interesting. With AppLovin, you got this. If you want to look in the dictionary for the definition of operating leverage, next to the word operating leverage, you'll see AppLovin, the ticker, as the definition, because that's incredible what they're able to do with such little employees. Now, there's always the risk that when we talk to people who are in the industry of ad tech, they no longer say that AppLovin's a fraud. They'll say AppLovin is aggressive. But there's always a risk that something occurs regulatory-wise, which always keeps me concerned. And that keeps me from making AppLovin like a really big position, always. So I just keep it almost like arm's length a little bit, but appreciate the business for what it is and what the team's done there. It's incredible, the numbers. If something comes about that, I didn't understand, that's why you position size accordingly, because it's reflecting the lack of understanding. So all I'm saying is that that's impossible to really know because I don't have access, and nor would I understand really if they threw it in front of me in a day what the algorithm is doing. That's black box to me. All I can see is that money go burr out of the company. Does your team own QXO? I'm building products this week, but Jacobs. No, we don't own it, but it's on our watch list. What do you think about a play on duration bond portfolio? Have seen banks overextending themselves. No, actually, U.S. banks have been really, I think, are pretty healthy right now. So I don't think they're overextending themselves right now. But if like you're saying that rates are going to go down, I don't know, because remember, rates are also a function of what the market thinks we're going to grow at. So it's not just inflation. So it's some relationship, and inflation is related to growth. So because if aggregate demand rises but the supply doesn't rise, that's growth, and that can cause inflation. But so they are related. But really, long-term rates are a function of unknown function between inflation and growth. And so rates could also go up because the bond market is thinking the economy is going to grow a lot more. And there could be a scenario where long-term rates decline and growth increases in real terms, because it's going to be a supply-driven inflation and not a demand-driven inflation or demand-driven growth. We saw that right in like the 1800s and the like. So that's possible. But and that would be a scenario where you have economic growth, but interest rates, trend down. But we haven't seen that in a long time, but it could happen. I mean, I don't know. Why is Toast getting toasted? Lumped in with software. Axon been collapsing recently. Too much SBC. Let me see what price it is. How much has it collapsed? 376. I think also kind of lumped in with software. Yeah, the business is amazing. It's just always the valuation with this guy. Markets, no. Oh wait, I thought that was a ticker Win. I was like, I was looking to short all these sector, because if Win gets fucked, the one I actually wanted to short would get fucked. Well, I would still have time probably to short it. Anyways, I thought you were talking about Win. What you mean? How long you plan to keep SFM? Up 32%. I have no plans to close that position. I mean, that's in my PA. It's like, it's whatever, Hugo. We'll talk. You and me, we'll talk in CM if I ever get rid of it. Shift forward, solid results. 4 times still down, 52-week low. What's happening with that sector? It's lumped in with software. Now, Shift 4 has a bit of a complicated, books there, but yeah. CCB, my BBC. Give me the catalyst. That one is one where the earnings are the catalyst, because they fell on their earnings from misunderstanding what growth, because they don't have earnings calls. So there's a huge lack of communication, not a big following there. For full disclosure, we are accumulating CCB here. We had our target level, it hit it, and we're buying it. So we are now long CCB again. This is like the 3rd time we've owned it. That's something Michael has been really good at, with basically reading the chart like a freaking insane person. But yeah, CCB, the catalyst there is earnings. Ryan Spencer Group down, buyer avoid. I prefer Arthur J. Gallagher. Before, yeah, it's just higher quality business, better growth, or similar growth, but better business structure. Not priced at all, especially the new underwriting as a service that's basically launching now. This Andrew guy, man. Wow, WTF. All right, going through. I'm catching up. Oh my gosh. All right, just scroll down to see how many I got. Defend. Oh, there you guys are all talking about Andrew. Booking Holdings is very long history of. Nothing screams to me as to why Booking Holdings here and now, other than, you like the business, you like the compounder, and you just buy it and hold it. But Booking is one that near term, they actually are getting hit. Okay, because we were just talking about demand destruction. They reported some weakness internationally, and I didn't know the stock price had fallen even more. So if you have a longer term view on it, I think this is one you could hold your nose and pick up some shares, but fully expect it could still re-rate lower. It's still trading at an elevated multiple. It's not like something, oh, I'm picking this up for nothing. But yeah. Thoughts on Rocket? I know that if you have a longer term view on housing, I think it's good to have, but it's not I wouldn't endorse like a large core position in it. Nothing that matters for investing and making the decision. Thoughts on Zeta? I'm looking at Zeta. Zeta is interesting. It's growing a lot, has a lot of retail interest, which kind of puts me off a little bit, but try to not let that cloud me. Don't have a exact opinion on it yet, like whether or not I'd buy or not, but yeah. Flutter Flutter's one that I did tell CM, at 300 I was out. I told Alaka, I'm sorry, I'm picking on you. I did say like the reason why I was out, and it had a lot to do with prediction markets. Prediction markets, I had no idea why they weren't affecting the perception at that time, and I think just the street was really late to it. I already tested the product for fun, and I was like, okay, this is actually a much better product experience for the normal person, and so it's gonna take a lot of the growth out of it potentially. But if there is like regulatory changes that could benefit Flutter is cheap, could get cheaper, it's doing buybacks. But yeah, gambling market as a whole, I don't know. It doesn't, compared to other things right now, it just doesn't scream out to us. I think you're still, nope, not in Evolution Gaming. The numbers are insane, yes. Lots of talk about Anthropic, OpenAI holding up the market. Are they on the well, first of all, these companies are set to hit together between the two of them 200 billion ARR by end of year. Yeah, it's pretty insane at this point. If they hit that, but anyways, like there's actual earnings to it. Someone's asked me to bring up Copart. What about Copart? Is it something happen after hours? I don't know about. They're doing buybacks now. This is another one that's on our list to look into more. Go up. General Mills died, just like they're gonna blame the consumer being weak. I guarantee you. Did they report today or something? Point, how much is AI investment incorporated into current rate philosophy at the moment? Would we see rates possibly trend down as business invest? Yeah, exactly. This is a possibility. We could see a lot of growth and rates trend down because of the supply increase, and the demand doesn't actually keep up with the supply increase. So productivity could actually be a huge benefactor. So you could actually end up having economic growth, but not deflation, but disinflation, or very little inflation, maybe deflation. Who knows? What's my opinion on Vistry? Vistry's British, bro. I would avoid it. Oh, General Mills is at the 2009 lows. Let me go back to FinChat and let's take a look at it. Look at it. It's getting close. Yeah. Oh, sorry. Bombarded with questions. No. I'm here for the questions. So Barbara question, I appreciate your takes. I like Reddit here. Huge margins, crazy fast growth, infinitely scalable trade. I don't hate Reddit. I just don't think they're going to be able to achieve like meta level monetization, but that's not the story you need to play for. I read a note the other day that Reddit is going to be able to improve their contract with Alphabet and get like 10 times more than what they're currently getting. So I think if they're getting paid like 60 million, so they'll get paid like 600 million, give or take. That's bullish, right? Because that's like money that goes straight to the bottom line. Yeah, no, I don't hate it. So yeah. That's what I'm looking at. A lot of AA, AAA rate corporate bonds at the moment offering 8%. Yeah, I mean, if you want to play the duration trade, I mean, if you have a view on that, it's fine. I mean, and what's the worst thing that could happen? It's more opportunity cost anyways, right? In terms of loss. But yeah, no, I don't hate your trade idea here, going long duration. It's not a widowmaker trade. You're not basically. This is when you tell me no, but I'm thinking about doing it with 50x leverage. I'm like, oh, no, don't do it. Okay, so I'm going through the start questions. Thoughts on Jackson at this level? Jackson, man, is like always cheap. I think they're cheap. I think you can still nibble and add here. Let me make sure I am up to date with the current price. Yeah, 108 is fine. Also, Dave and AFRM when you get the chance. Dave is super cheap. We'll buy back even more stock. The capital unlock is happening this summer. It's literally just moving on technicals, which is hilarious. It's supposed so. Dave chart actually, we have it on our calendar next week. It's set to resolve up or down. We'll see what that is. Vistry. Bad news. Vistry doesn't stop. Yep. Vistry continues to just be an absolute shitco of a mess. The next NVR, as they say. Look at that. The next NVR, ladies and gentlemen. Toast below 23 is interesting. Yes. If you have a long-term view on it, absolutely interesting. I already answered that one. Thoughts on Turning Point Brands after the recent FDA? I am more bullish than before. And I think one of the largest risks just went kind of away. Kind of, not fully. Why don't you never talk about STM? Because I don't want to. We'll talk about it. So, for full disclosure, we are pretty long STM at this point because it's been growing. But yeah, we pitched in CM already the power semi thesis, and that one's a play that's only going to realize in terms of the actual numbers by 2027, but the market's reacting ahead of schedule, or not ahead of schedule, right on time, but ahead of the visibility on those figures. So STM, from our research, we think is going to be the best positioned to capture it. You have Infineon, that's the current leader, but STM is our favorite when we looked at all of them. And so far, we're really happy with our decision. I already disclosed that we're long. And yeah, that's I haven't talked about it because that's for you guys first. Or I don't know if you're in CM, but I think Alex, you're in CM. Alexis, I think. But that's for you guys first, and then we can talk about it here. Thoughts on Google providing 99-year bond offering at some point? CapEx has to stop, right? Can you do CapEx and raise dividends all at the same time? The question is only if the CapEx is resulting in operating profit growth. If it is, then yes. If it is, then simple answer, yes. That's the only question you have to ask with all of this CapEx from hyperscalers is are they getting a a visible increase in operating cash flow from the investment? If the answer is yes, you're wasting your time on on the other questions. Well, no, there's other questions you got to ask. So like by how much is the increase? Because if you're spending like, I don't know, hundreds of billions of dollars extra and you're only getting like a return on that money of like 5%, what the hell are we doing here? But no, if you're getting a remarkable increase in the return on that capital, it's not a waste. Do more of it. In fact, as a investor, you should say, please do not give me my money back right now. Do more, buy more, invest more, compound my capital. And that's what we're seeing. But I don't know why folks are just like blind to it. And it's like all of a sudden hyperscalers became bad businesses. Like that was so new to me. I was like, wow. Cloud was always considered a very good business. Now, not everyone, no, and the market rewarded it, but like there was a time where people were implying that cloud is no longer a good business. I was like, what happened? What the hell happened? Okay. Also, what level investor do you have to be to join CM? No, there's no level needed to join CM. It's a community. We have I think people from all levels, all walks of life. We have folks that are whales. We have folks that are, just getting started. But if it's for it's basically like just good for people who want to have conversations. Like we've started implementing new tools, like and this is the what I love about the community, right? We have members that are willing to add value, and either from their own research, their own analysis, also implementing AI tools to provide sort of like summarized content for people who have really busy schedules. Of course, it's always encouraged that you participate in the nearly daily voice conversations with either myself or others, but nearly daily voice conversations. I will say, I don't. I'm bad. I'm a bad salesman in that sense, but because I don't pitch it enough. But CM Club is like generally the way. If you want to talk to me nearly every day, if not every day, I'd say probably every day. It's the way to do it. Because I know a lot of other communities you can't really even talk to the person, but I make sure that I'm available pretty much to answer questions or talk every single day. Okay, I didn't want to say Fuhat level investor. I wanted to not say that, but yeah. We need at least 47 chromosomes. We require proof. Bought STM yesterday on pitch, and it's been great. Well, that wasn't the first time it was pitched, but I did explain it to you yesterday. Yes. Talk truth, my feelings, the tingling trousers. I'm always being right. You cannot join CM. Oh, okay. Okay. Yeah, that's true. But yeah, the only thing that has requirements is the fund. The fund is what we have. You have to be an accredited investor and all of the sort. But the club itself has no requirement. What price is Dave still a buy? That's a moving goalpost because the fundamentals are moving alongside Dave. So, a while ago, not too long ago, we would have said we're not buyers of Dave, past like 260. Like we would not buy more Dave, right? But, as things progressed, the fundamentals of Dave have improved. We were really perplexed that we were able to buy Dave in like the 170s. Like that was insane. But I executed a buy order today on Dave. Dave got into the 130s again. Just the other day, Dave got into also like the low 130s. I think even hit, I said 130s, 230s. I apologize, 230s. And then the other day, I think it sold off at one point pretty drastically to like the I think even like high 220s. So No, the fundamentals if you find a really good business with a really good management team, you could end up in a situation where you continuously keep buying and averaging up. One of the mistakes investors do all the time is that they sell out of the position completely and punish a really good company or a company that's executing with great management, etc. It's like Meta. I've added to Meta over the years. Um, it wasn't ever a one and done. The fundamentals improved, and I kept adding to the position. There's positions that have that in my portfolio. Amazon, I've added to over the years. Um, Dave, I've added to. So yeah, if Turning Point Brands is something I'd add to if the fundamentals keep improving and they keep executing. So it's not something that you just stop. But yeah, but for right now, I think we're comfortable still buying Dave around this level. I think it's decent, it's pretty good. And then if you're offering it to me for high 200s, I'm slowing off my buys only because of my current allocation. But depending on what happens with the BNPL product, that could be still like a company that's actually worth $500 a share in the future. We really don't know. I believe there was one last week that was recorded, but that's always dependent on the recording. If I'm at my desktop, so right here, because I can record it. If I'm on my phone, I can't hit record or anything like that, so it's a bit hard. Unless I like set up, some sort of AI bot or something to do it. But yeah. Booking, no strong opinion on the demand destruction. Like if you have a longer term view on it, I think it's a good buy. Outside the obvious shitcos, what stands out as most ridiculously overvalued name in the market to you? Ooh. So I'll go with like maybe a controversial one because I think that's what the spirit of your question. You don't want the obvious shitcos. I'd probably say I'll give you a few actually. I think some of the casinos might be overvalued right now. I'm floating the idea of shorting them. I'm not sure. Um, Especially the ones that are exposed internationally, but I've held off on them. More on overvalued because again, you don't want the obvious shitcos. I'd probably say some of these retailers are pretty egregiously valued. I get it that their business mix has shifted a lot, but I feel like you look at Copart. Copart was premium multiple for a long time, and then suddenly wasn't. So I think the same thing could happen to Walmart, to even Costco. You're great businesses. That's not what the question here is. They're great businesses, but do they deserve to trade at 50 times earnings? And if you told me, in 2 years' time, their multiple eroded. They didn't grow that much because they're not really growing nearly enough to match the multiple. And then suddenly you're able to pick them up under 20 times earnings each. I wouldn't be shocked. I wouldn't be like, wow, there's no way that could happen. So, but Walmart to me looks overvalued. Costco looks overvalued. So those are the retailers. I'd say in the tech space, big tech, Google is at this point has no risk implied in the multiple. So if any risk comes out at some point in the future, that could be problematic. I told Hugo, if Hugo's in chat, like I told him, keep some of your Google position, right? I don't think you should sell all of it, but I'm not even saying it's a short. I think you could short it on momentum if something negative comes out, because I think that it has some room to catch a bid on the momentum downward. You can clearly see that Google is capable of doing that from the past. It happens all the time with some of these mega cap tech, and Microsoft just did it just now. Everyone always thinks when times are good that these companies just don't have any momentum downward. It's like, no, they do it all the time. What do you mean? Like Microsoft's in the middle of it. And you could argue Meta's somewhat in the middle of it too. But yeah, that could happen with Alphabet, because a lot of that growth that Alphabet had in the share price, there was earnings growth and there was multiple expansion. So just looking at that, you could basically look at it and say at some point this multiple could compress from either something comes up sentiment wise, one thing or the other could happen. Right now, nothing is wrong with it, so the multiple is really high. Other ones that are probably overvalued. I'm trying to in my brain go around the shitcos. I already said the retailers. Everyone says Tesla. My brain went to Tesla, but everyone says Tesla, so it's boring to say. And there's like a world where Tesla goes crazy and figures something out, but so I'll avoid it. Definitely some stuff in semis. Avoiding the shitco names, but some stuff in semis, like Broadcom might be one that I think could be looked at as overvalued. I don't know. That one's I see the dynamics, that relationship between them and Alphabet, and I see like Alphabet kind of wants to bully them a little bit, and the market's not pricing that in at all. But also I don't know what the actual impact is going to be, so could be talking out of my ass there. I wouldn't say AMD technically because it's unknown how much this impact is going to be from the CPU demand, etc. Semis are definitely overvalued if the cycle ends this year. That's the end of the cycle. They're all going to be overvalued and they're all going to crash and burn and die. Software is pulled down a lot. So there was a lot of software names like Atlassian that were crazy overvalued that made no sense, but the multiples come down so much. Wouldn't say they're crazy overvalued now. Yeah, no, I'll go with those names, but because I'm trying not to use shitcodes per your parameters. Oh, Cloudflare. Well, yeah, Cloudflare is expensive. Oh, no. My mind just, okay, you just helped me out there a little bit. Yeah, CrowdStrike, Palo Alto, Cloudflare, a lot of these co-ops, companies that are just like there to basically use all their profits in SBC. Ridiculous co-ops. My mom works at Walmart, has been buying stock from them from her paycheck for 25 years, planning to retire on it. I'm hoping she's going to be good in 5 years. If she's been doing it for 25 years, she should be good. But I would tell your mom to, I don't know the full story, but like diversify, buy the index. I definitely buy the index. No need to have all your eggs in one stock. Definitely buy the index, or tell her to buy the index. She can have her eggs in a lot of baskets. Don't mess with that for retirement. Again, I don't know if what you're saying with me is that all she did was buy one stock. If she did do that, I mean, I don't know what kind of account it is. I don't know her tax situation. I don't know any of that. But like, it's a conversation we had. It's like, hey, there's such a thing as unnecessary risk. You've done really well, and she's benefited from multiple expansion. Here, let's actually illustrate this point. And Walmart has improved as a business, so it's not that it's not crazy or undeserved or anything like that. There's reasons for why this happened, but nonetheless, I have to point this out. That much of the returns here, and maybe I need to smooth this out, to be honest, because PE might not be the best one. We'll do. So it's kind of the point I'm making. Okay, good. So she has her 401k in SPY. All right, so here's the next context. Okay, yeah, that's fine then. That's fine. Yeah, that's fine. But yeah, a lot of the returns here, this has helped her a lot. So imagine her returns are actually really good, because that's the beauty when you get, you know, the improvements in the fundamentals and multiple expansion. But the reverse is also true. You could have improvements in the fundamentals, but don't underestimate that multiple contraction can be really bad to that forward return. All right, so something stupid will happen and Google will drop under 300 at some point. Google is dead. There's no in between. Exactly. Tell her to buy a tape. No. It's a good business. Working capital cycle means volume funds, business itself, free cash flow. Yeah, no doubt. Great business. Mm-hmm. Yeah. And I think that's yeah, exactly the point. So it's pricing in that it's a phenomenal business. Absolutely. And a lot of what's changed in the business, it's become a lot more recurring in nature. Walmart Plus has been a success. And the like advertisements becoming more and more of a thing. So there's a lot of things to like with Walmart. The business itself, great. But you know, if I buy shares today of Walmart, what is my upside from here? Is it going to is the multiple going to double again? Are the earnings going to double? What's going to double? What's going to give me that attractive rate of return, or what's going to cause it? Or is it going to now more or less it's gotten most of the lion's share of the return, and now it's going to just give me a steady state, maybe market rate or just under market rate of return? And am I willing to accept that with the risk that something can occur in the future that the market then says, I don't like this business anymore, or I feel a little bit off about this business? And I, as everyone can appreciate, time and time again, that happens all the time to businesses that were beloved, and then they're just like, oh, you're disgust me, get out of here. Yeah, that's really cool, man. That's always cool when someone who works at a company that's been really successful, and then they're buying the stock again and again and again, and they just get really rich off that. Those are the cool stories. Do you predominantly use Perplexity Finance? I use Perplexity now for most things. It's replaced my browser, the way I interact with the internet. I can't go back, to be honest. But yeah, so then by proxy, I do use Perplexity Finance. Yes. Yep. Yeah. That's true as well. Okay, so I've answered all the questions. We talked about oil. We talked about semis, hated rally. And we're coming up on the 2-hour mark. So I'll say, to summarize everything, there's a lot of doom and gloom out there that is persistent, comes in and then goes away, comes in and goes away. And you might hear those voices get louder and then go away, and then they get louder again, they come back. But what I think is that I remain structurally bullish. And in fact, a lot of the things that I was only concerned about, the probabilities of their occurrence is diminishing in my eyes. And the businesses that we talk about and are invested in, I think they're still, got their best days ahead of them. U.S. economy still looks pretty healthy, pretty good. A lot of people, I think, are misreading some of the figures, to be honest. Yeah. Oh, there's 2 more comments that came in. We had an ICOM last week, David Kim. And I think we're scheduling one for tomorrow, for Thursday night. All right, tell your mom to take her Walmart profits and split the proceeds between QBT. Oh my gosh, no. Oh, Walmart is the reason why I don't like CPG companies like PG or Costco. Yeah. Yep. Yeah, they have all the power. Yeah, it's pretty crazy. And a lot of people didn't see that shift back in 2017. I participated in those debates, by the way. Fun fact. On so back in like 2017, when like Procter and Gamble was going through its transformation with pelts, a lot of the investors, I wasn't on YouTube obviously, but a lot of the investor discussions and debates around it was Procter and Gamble's inability to fight off these power dynamics between Walmart, Costco, and them. And a lot of the bulls at the time were saying, oh, you're young, you just don't understand. I'm not even kidding. They didn't really have a good answer to it. And the concerns that I was on the team saying the power dynamics are so much shifted now towards the retailers that are moving so much volume, and Amazon also is getting stronger and stronger and stronger back in those days. That Procter and Gamble and all these consumer companies, they're just going to get squeezed, and it's going to be harder for them to grow. On top of the fact that if the generation, my generation and the millennials, they're more price conscious, they're more like less brand loyal than older generations have been. So it's always been a problem. Anyways, you just remind me of that conversation. China to rocket post-Trump deal. Well, it depends, man. And a view on China's economic future. I mean, if they choose to not proceed with conflict with the United States and actually choose to back off and not invade Taiwan and not do any of those things, their future could be brighter for sure. But if they choose not to and they choose to continue down the path they were before, then no, it's not going to be good for them. I mean, they're going through a pretty tough cycle right now, something that would make the U.S. blush. But it's I haven't seen the most recent data, but it doesn't appear to be staving off. The real estate market continues to experience a bit of a turbulence, so to speak. And of course, there's like a lot of questions within the Chinese data itself. But if they choose not to engage in a conflict with the United States, then globally that would be positive for the global economy. But China, it has its issues structurally that will prevent it from ever being too prosperous, unfortunately for them. They can choose to remove those obstacles, but that's easier said than done as well, because they also don't want to relinquish control. And part of that prosperity can come from relinquishing more control. But they have different factions that want different things. Some of them would want to do that. Other factions that are a bit louder right now, not really. She's factions all over the place, but they have a few factions that are a bit louder on the opposite side. That sounds like that. I did not know that the Elf founder did that. That is funny. Okay, so you buy emerging markets if you think the oil pain trade is going to stop. But yes, I'm interested in emerging markets. In particular, my watch list consists of Grab, Mercado Libre, Nubank. That's like my short list right now of emerging market stocks to capture various different economies. Grab Southeast Asia, Nubank, you get Latin America, Mercado Libre, you get Latin America. I imagine I can go into other EM countries and find other things, but yeah, I'm interested only as a play to relieve or play the relief of this oil pain trade that's mainly destroying emerging markets. I have not actually looked at PetroTal's earnings yet, but yeah, no problem to mention them. So, I mean, you're basically with PetroTal picking up something that has a higher PV value than what you're paying today, and it was a bit distressed. Let me see. Let me pull them up. Yeah. So even still at this price, right? Because think about it, like the theoretical present value of the reserves, and how it's going to be returned to you makes sense. And here's like a sort of an expansionary commentary on why, for PetroTal, the best form of capital return is actually a dividend. One of the oil guys I respect, not in CM, he's worked in the field for a long time. He's retired now, but one thing that was explained that makes a lot of sense when you think about it. When you have a shorter life of your reserves, his view or what he prefers from an oil company is he wants a dividend. And he doesn't actually like buybacks. He wants all the cash flows to be distributed out in the form of a dividend, sort of cash cowing the business. But if you have a business that has a massive present value, or a lot of the valuation is done by the massive amount of reserves it has, and the market doesn't really price in too far out into the future, then and he thinks it's wrong, then he prefers like a buyback. And so the example, here's another oil company I like. So ATH trades on in Toronto. There's an ADR. It's none of these. Let me do CA. Yeah. No. I'm gonna find it here. Here it is. So this is the one I like. It actually hit a new all-time high today. This is the one oil company I think is like, just buy it and hold it if you want oil exposure. It's fantastic. Anyways, what you get here is probably the largest reserves out there. Period. End of story. Like, we're talking like you're gonna die before they run out of reserves. So then, how do you assign? What's the value of all that? Higher than today's share price by a lot, but the market will never price it really appropriately. It's very difficult for the market to price it appropriately. And the management team here knows this. And this is, again, I'm sharing with you the information in that conversation. So here they take the opposite approach, no dividends at all. So PetroTal has just over 10 years left. So you want dividends, theoretically, you want dividends, and you're going to get all your returns back in dividends. And PetroTal is cheap enough that you're definitely going to get all your money back and then some in the form of dividends. And that business will wind down at the end of its life. And ATH over here, conversely, this one's going to be all buybacks. So it's not going to do any dividends. It's only going to do buybacks. And that makes a lot of sense for them. So you have like the polar opposites. You have PetroTal, which is, it's not super short reserve life, but it's sort of closer to the other side of the spectrum than here. And then Athabasca is much more, extraordinarily long duration assets. And how do you price that? And the same thing goes for like although the multiple is a lot higher, but AMR, so for coal, Alpha Metallurgical Resources, I believe their reserves for coal are like 80 years or something. So very long. Warrior Met Coal is like 50 years. So then what do you put a value to that? You got to figure out, you got to have like some opinion on what the metallurgical coal and the thermal coal, what price it's going to be at. But and then from there, you can sort of figure out what is the present value of all that. But you're basically going to get all of that cash flow out to you. And in theory, if based on that, you really don't want a dividend out of this. You just want buybacks. So yeah. So there's a concept in economics, you're measuring the wealth effect. When people feel that they're richer, they will spend more. The US has done a good job through 401ks of dispersing this effect into the markets itself. So Americans actually do get to feel, to an extent, the movement of the markets, and they'll feel richer. If they feel richer, they'll spend more. So when we look at housing data, if like housing prices go down or if the stock market crashes, you'll actually see a measurable change in spending behavior of consumers. So an example, if your account's up like 100%, studies indicate you are, maybe you're the exception, but if you're a normal person, you're more likely to go out to that restaurant and spend money because you're like, I made a lot of money in the stock market. If your house doubles in value and your mortgage rate is what it is, you're more likely to go eat at that restaurant. That's basically why we look at that. So the wealth effect. But yeah, that's the gist there. Oh, I see. Thinking Macro explained it here too as well. Yeah. Yep. And it's personal balance sheet. Yep. Yeah. And the banks have been telling us that they're healthy. Oh, thanks for the super chat. Gonna look into some of these. Thank you, sir. Well, thank you for the super chat. All right. But yeah, I'm happy to share some of those names with you. Okay. Do you have an ideal why selling off and looking at TSCO? Why do I not remember what TSCO ticker is? I don't. Tesco. Oh, Tesco. Is it Tesco or Tractor Supply? I think he means Tractor Supply. I think Tractor Supply is a. Oh my god. Tractor Supply just died. Anyways, I know what's going on with Tractor Supply. Tariffs. Definitely tariff impact. Maybe something else is happening. I can't really opine further because that's a dramatic drop. What the hell is going on there? But Dollar Tree, well, dollar stores still are still facing impact. The fundamentals for Dollar Tree, though, they've gotten a lot better. They're getting same store sales growth. They're not very levered. There's a lot to like there. The new pricing model is also working, it seems. What's the price at now? Did it break 90 yet? DLTR. Let's see. Dollar Tree. It did break 90. Man, what do I do? Because what's Dollar General doing? Damn. I mean, these are. I'll look at them because that's interesting. Also, I saw VG and their earnings started a position. Yeah, Venture Global. Our opinion on that one. Basically, Venture Global, I think, has a lot of potential in the future. Some of the oil guys in the community, they were concerned about the lawsuits. Some of those concerns tapered off. They won some of those. They lost only one, I think. But LNG probably still the better blue chip play in that space. But Venture Global has some really interesting assets that once they come online, there's going to be a lot of earnings potential from them there. Yeah, no, I don't hate the idea, Venture Global. The tariff pressure on some of these names will be revealed after a change in presidency. Yeah, maybe. Well, remember when Biden came into power, he didn't remove the tariffs from the Trump first admin. So remember, foreign policy wise, administration are much more aligned. The flavor, the language changes a little bit, but high level stuff sort of maintains. But maybe, yeah, who knows? Hard to predict because I don't know who's going to take power. It's not like it's perfectly stable or perfectly the same. either. That's not true either. Wait, that's actually a really funny comment. Presidency isn't going to change anymore. Fuhat, we have missed you. If only you didn't break the rules. So once you have returned, we can talk. Just don't break the rules again, buddy. I must enforce all rules equally. All right. Portfolio management question. If you're buying a stock with it in mind that value you think is going to reach, it reaches that value. How do you handle that allocation? I don't like to punish winners as much as I can help it. The valuation has to get undebated. Like I like to have a threshold of like there's no debate about the valuation. That's subjective, I know, but like let's say if within the realm of reason, someone could argue a scenario by which the stock I own is still at fair value to undervalued, even though maybe I don't necessarily care to buy it. I probably just continue to hold it because maybe my expectation of buying is like really egregious, but I might just continue to hold it because also considering taxes, etc. But if I do think it's going to sell off, then yeah, I'd probably sell. Or if I find something I think is better, that's another thing that could cause me to sell. If I find something that is like, oh, this is a better opportunity than this opportunity, and even accounting for taxes and everything, this opportunity kills it, I'll move the capital. I also go back to the revaluation to make sure, right, that the fundamentals haven't changed. Like as we're looking through Dave's price continues to rise up. Dave's price was much lower before, but Dave can still maintain being undervalued even as the price goes up because the fundamentals are improving. It's not just like any multiple expansion. But yeah, you always want to do that with all your positions. Reevaluate because when I first bought Meta back in 2022, I said to everyone, "This like my retirement goal would be hit if Meta hit $400 a share." Meta, last I checked, is over $600 a share, and I'm still buying. Well, 400 wasn't really a price target, but it was a goal. It was like price goal. It's not at 400. I sell everything. Nope, 400 I didn't sell any. So the first big sale of Meta I did was last year at 700 something, and I used that money to start Fraxinus. So Fuhat said a bad word. Do you still see chip packaging as a bottleneck? Yes. ASX is still interesting. Yes. I prefer power semis, but yes, ASX is still interesting. Yeah, Meta was such a good buy back then. Are neoclouds like CoreWeave needed as capacity for hyperscalers becomes available? Isn't investing in that sector? Yes, very risky business. We have a shorter term view on them. So far, we're right, but the shorter term view is that the market, the compute demand is so great, they're all going to just get a bid from that. So like you look at Nebius, CoreWeave, IREN, they're all pretty strong. All right. Well, with that being said, thank you guys so much for joining me today. It's been 2 hours and 17 minutes. It's been a pleasure. Like always, if you guys enjoyed this live stream, like, share, subscribe. Love to see you guys next time when I do this. And if you're curious, all the sponsors in the description below. Number one sponsor is myself, Capital Mindset, and then also FinChat, which I believe is doing a sale that ends today, I believe. With that being said, thank you guys so much for joining me today, and I'll be seeing you guys on the next one. I'll leave you guys with an outro that we haven't done in a while.
We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.